Okay, so this is Tax Tips for Dentists, and I am Jessica Chisholm, CPA here at Huddleston Tax CPAs. So the things I'm going to go over today are entity selection, the auto deduction, home office deduction, dental equipment buying versus leasing, which is best for tax purposes, hiring family members, deferring taxes, payroll taxes on owners, and then some other miscellaneous deductions to remember. So first with the business entity selection, when it comes to choosing the best entity for your business, there are several different choices. So the different entity choices you have are sole proprietorship, LLC, partnership, C corporation, and the S corporation. So the sole proprietorship is the easiest to start, but it also, you have to pay self-employment tax on all of the profits. For most years, that's 15.3%. For 2011, with the lowered Social Security rate, would be 13.3%. And then the sole proprietorship, it just gets reported on your Schedule C of your personal Form 1040, so there's no need for any extra tax returns to be prepared when you're sole proprietorship.
Okay.
For the LLC, a single member LLC would be taxed as a sole proprietorship, or could make an election to be taxed as an S corporation. If you're a multi-member LLC, then you need to report the income on the partnership Form 1065. So a single member LLC, when you don't make the election to be an S corporation, you are just taxed as a sole proprietor, and you just still pay that self-employment tax on all of the profits. If you make the election to be taxed as an S corporation, then you get all the benefits of being an S corporation for tax purposes, and I will talk about the S corporation in just a second. If you're a partnership, there's 2 or more owners sharing in the profits and losses, then you would report your income on the partnership Form 1065. And again, and the partnership income flows through onto your personal tax return with a K-1, so there's no tax paid at the partnership level. But all of that flow through income when you're a general partner is subject to self-employment tax as well. And then there's the C corporation. The C corporation pays tax at the corporate level, and then if you're an owner and you take dividends out, you're taxed again on those dividends. So that's when people talk about double taxation, they're talking about C corporations. And the only ways to get money out of the C corporation as an owner would be to take a wage or to take dividends. I mean, and either way, you're taxed personally on that income again. Then there's the S corporation. It avoids the double taxation of the C corporation because it's also, like the partnership, a flow-through entity. So there's no tax on the S corporation. All the income flows through onto your personal Form 1040 using a K-1, and you're taxed on the personal level. There also is a way to save on the self-employment tax with the S corporation. So when you become an S corporation, the IRS requires you to pay yourself a reasonable wage out of the corporation when you're an owner. So, for example, an easy way, a way to think about what a reasonable wage would be is what you would need to pay someone to replace yourself in a business. So if you're a dentist and you have a dental practice, you would need to pay yourself a wage that would be reasonable to what you would pay another dentist to work in your practice.
Okay.
So the way you would save on self-employment tax is if you had, say, a net income of $100,000 for the year, and you decided that a reasonable wage would be $75,000, then there would be that $25,000 difference between your wage and the profit. And you could take that $25,000 as a draw out of the corporation, and that $25,000 would not be subject to self-employment tax. So you have to think about at what point the S corporation makes more sense for you. But for more details on how S corporations can save you money on taxes, John Huddleston, and another CPA here, does a webcast called LLCs and S Corps Explained, using them to reduce taxes. So if you have any questions on entity selection, that's a really great webcast to check out because he goes into it in a lot of detail. Okay, so the next thing I want to go over is the auto deduction. So there are 2 different auto deduction methods. There's the standard mileage deduction and the actual expense method. The standard mileage deduction is the easiest to take. and requires the least amount of record keeping. I haven't updated this slide, but for 2011, it's 51 cents per mile. So what you need to do is keep track of your business miles, which would be trips to buy office supplies, trips to meet with clients, the post office, the bank, anytime you're driving anywhere for business.
Okay.
You'd need to keep track of those miles, and then at the end of the year, you would multiply them by the 51 cents, and you would get your deduction for the year. But you need to note that business miles do not include trips from your home to your office. That's considered commuting miles and aren't business miles for this deduction. Although one way around that is if your home office is your principal place of business, but most dentists can't make their home office their principal place of business. So then there's the actual expense method. So that's, you would need to keep track of all the actual expenses to operate your vehicle: gas, repairs, oil changes, loan interest, tires, licensing fees, anything that you would pay, insurance for your car. And then you would also need to keep track of your business miles to determine the business use. So if you're doing the standard mileage deduction or the actual expense method, it's a good idea on January 1st to write down the beginning mileage on your car. Then throughout the year, keep a mileage log. Every time you drive somewhere for business, write down the miles. Then at the end of the year, you'd write down your ending miles on your car. Add up all your business miles for the year, and then figure out your total miles driven for the year, and then you would get your business percentage. So for the actual expense method, that's how you determine what percentage of the actual expenses you would take as a deduction. Also, when you're doing the actual expense method, oftentimes you can take depreciation on your vehicle. So the times that actual expense method are used most is if you have a 100% work use vehicle or one that's pretty close to 100% business use, because then you're able to take the depreciation on the vehicle, and that the actual expenses oftentimes will exceed the mileage deduction. But you need to note that you cannot switch back to the standard mileage method once you use the actual expense method. So if you buy a new car and you put it into service and you realize that the actual expense method is going to be the most in the first couple of years and you elect for that, you can't switch back to the standard mileage method for that car. So you have to keep using the actual expense method for the life of that car. So it is by car. You don't have to elect the standard mileage method or the actual expense method for all of the autos if you use more than one in your business. Okay. So the next thing is dental equipment, whether it makes more sense to buy or lease for tax purposes. So when you lease equipment in your practice, the lease expense is deductible as it's incurred. So you'd pay a monthly lease expense, and that would just be an expense on your tax return at the end of the year. When you purchase equipment, it needs to be depreciated over the useful life. So if you purchase a $100,000 piece of equipment and the useful life is 5 years, you would get to deduct $20,000 per year on that purchase. So it does get spread out over several years. However, there's something called Section 179, which allows you to expense the full cost of most equipment in the year purchased. So if you bought that $100,000 piece of equipment, you could take Section 179 on it the year you purchased it and deduct the whole $100,000 that year. If you sell it or get rid of it before the end of its useful life, the 5 years, then you might have to have some depreciation recapture as income. But usually you're going to be keeping the equipment longer than the 5 years.
Okay. I do have a question on this.
Sure.
This is where I've had some clients that have purchased the equipment in their kid's name and then are leasing it from their children. Is that something you've heard of before? Is it illegal?
I actually have heard of people doing that. It just kind of gives some income into their kids if they want them to have income on their return, or for them personally.
The one gentleman that I know of that was using it, I think to full tilt, was using it to fund for his daughter's eventual college planning. So I guess I don't ever quote any taxes or anything like that, but I was a little surprised by that there would be a loophole like that allowed. So
yeah, well, they can do it. I mean, then it causes the kids to have to pay tax And usually, you know, with the kid tax, since that's unearned income, they're going to have to pay tax at the same rate as the parents.
Okay.
Some people do it, but it doesn't save you in tax money.
Okay.
Yeah. So let's see. So when you're talking about Section 179, any office equipment and furniture that you purchase you can also take Section 179 for depreciation on those purchases. Also, equipment doesn't have to be fully paid for to take Section 179. You can finance the equipment and still take the 179. And when you finance the equipment, the interest is an additional expense for tax purposes. So maybe you buy that $100,000 piece of equipment, you finance it, you know, you put, say, 10% down and finance the rest of it. Any interest that you pay on that loan for the year is deductible in that year as a loan or an interest expense on the tax return.
Okay.
So most people, for tax purposes, usually buying the equipment will save you more in tax dollars, but at the same time, you know, there's more than just the tax aspect of it to consider when you're trying to decide if you want to lease versus buy.
Okay.
Because, you know, it is a bigger upfront cost to buy than it is to lease it. So next is the home office deduction. So, you know, you're not going to find very many dentists that are practicing out of their house. So you know, usually the home office is not going to be the principal place of business for a dentist. However, to take the home office deduction, you only have to meet one of the following requirements. It needs to be your principal place of business, a place where you meet clients, a separate structure that's not attached to your home, or a place where you store inventory. So basically, if you're a dentist and you have your dental practice, but you also do all of your administrative work out of a home office, all of your paperwork, all of your billing, a significant amount of your business time is spent in your home office, you may qualify to take the home office deduction. It does need to be a dedicated space in the home. So if you have the office in the home, no guest bed, nothing else is going on in that room other than work for the business.
Okay.
And the way you would calculate the deduction would be using the square footage method. So if you have a 2,500 square foot home and your home office is 500 square feet, then you would have a deduction of 20% of what it costs to operate your home. So you'd be able to deduct 20% of your mortgage interest, property taxes, homeowners insurance, utilities, and if you rent rather than own, then you would get 20% of your rent. And also, if you use your garage to store inventory or a 100% work use vehicle, you may be able to deduct that space as well. So maybe a dentist has, you know, dental inventory, that things for the office that they store in the garage and spot. You might be able to deduct a percentage of the garage for that.
Okay.
So next is hiring family members. So you can employ your spouse or your children in your dental practice, and you can claim their wages as an expense. So if you're going to hire your spouse or children, you need to be sure to keep excellent records of when they work, what their jobs are, and the pay needs to be reasonable for what they do. So you can't pay your, you know, 14-year-old kid $30 an hour to empty the trash. It needs to be, you know, comparable to what someone else would be paid. So paying your spouse may allow them to contribute to a retirement plan in their own name or allow them to get wage credit towards their Social Security. If your child is under 18 and your business is not incorporated, so if you're a sole proprietor or an LLC, then there's no payroll taxes that need to be paid on your child's wages. So you don't have to withhold any Social Security, Medicare, federal withholding on your child if they're under 18. And for your kids, you can pay them up to $5,700 if working for you is all they do, and they won't have to pay any income tax because of the standard deduction that they would get. So it's a way to hire someone to work in the office for a minimal cost, and it would allow your spouse or your child to earn some money. So it's something to keep in mind. And next is deferring payroll taxes on owners. So this would apply to C corporations or S corporations, since LLCs and partnerships and sole proprietors owners don't get paid wages out of those entities. So if you're a corporation owner and you're also an employee, you can defer some of the payroll tax obligations on your income until the following year, or even just wait to make the federal withholding tax payment until the end of the year. So basically what you do is you would pay a large percentage of the owner's salary at the end of the year, and then the payroll taxes wouldn't be due until the first of the next year. So if you're a monthly tax depositor and you pay yourself a wage in December, the payroll taxes on that wouldn't be due until January 15th. So if you're trying to get some of your expenses for the year into the following year, then this is one way to do that. And also, a lot of business owners are required by the IRS to pay quarterly tax payments to cover their tax throughout the year. But if you pay yourself a salary, then you can have your federal withholding taken out of your salary, and that federal withholding is treated as being paid evenly throughout the year. So that would get rid of the requirement to make the quarterly tax payments. So if you need to make quarterly tax payments that total $10,000 for the year, you need to make $2,500 a quarter. If you just wait until December, pay yourself a wage, and have $10,000 of federal withholding taken out, then that covers those quarterly tax payments for the year. So you're able to hold on to that money longer, basically. And some people say, well, I need that payroll check throughout the year to cover my expenses, my personal expenses. But that cash flow throughout the year can be met by using draws or loans to shareholders out of the corporation. Then in December, when you made that large payroll check, you can just use that to offset the draws or those loans to shareholder at the end of the year. So then there's just some other miscellaneous deductions I wanted to point out that you should remember. For dentists, continuing education that you pay for throughout the year is a deductible business expense. Also, retirement contributions would be a deductible expense. So if you own your own business, it's good to look at different self-employed retirement plans that you could take advantage of for your business. That would be a deduction to your business, and then also would help you contribute to your retirement. Also, interest on any loans that you have for the business, that interest is deductible as an expense. Medical insurance for you and your family would also be deductible. And then meals and entertainment is one to remember. For meals and entertainment, those are deductible at 50% unless you provide meals to your employees as a convenience to yourself. Basically, if you want to try and keep your employees on the site, don't want them to leave at lunchtime, you can provide meals to them, and that would be deductible at 100%. Also, for meals and entertainment, it's important to remember that you need to know, who you were with, where you were, what it cost, all those important things. So it's good to keep the receipt for the meal you have, flip it over, write who you were with and what you talked about, and keep that in a file in case you're ever audited.
Okay.
So that was everything I needed to go over today. So did you have any other questions about anything I went over?
Well, no, and like I said, I'm glad that you took time to go ahead and go through with this. I thank you for that, just having me here, because I do have roughly 18 to 22 people in the dental world around Redmond and North Bend, Snoqualmie, and that. So, anything I can do to stay helpful with their line of business or point them in the right direction,
right,
is helpful in both sides of the business. I don't know. I think the information you give here is quite helpful. Do you by chance do seminars or something? If I was able to get, say, 12 or 14 of them together and I bought lunch type of thing, is that something that you'd be?
That's definitely a possibility. If you wanted to email me maybe with some more details, and you could talk about that.
Listen, I'm always just, every time you can get in front of them personally, then sometimes that gets more conversations going.
Right.
It can be good for business for both of us. So. Right.
And yeah, again, our website is just Huddleston Tax CPAs.com, and if you You can feel free to email me about something like that.
Okay.
My email is on the website, and also we'll be emailing you the PDF of the slides so that you can look those over, and that has all my information on them as well.
Okay. Well,
So,
thank you very much.
Yeah. You have a good rest of your day.
You too. Bye.
Thanks. Bye.